The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone, and welcome to the May webinar titled Taxes After the Fiscal Cliff, Planning Opportunities in 2013, courtesy of Putnam Investments. We appreciate all of you taking the time to join us today. This webinar is part of our monthly webinar series, and today we will be taking a look at the current income and estate tax landscape, as well as the legislation signed into law to avoid the so-called fiscal cliff. A few housekeeping items before we get started. First, please note that in order to ensure everyone has the ability to hear the information presented by our guest speaker, everyone will be on mute during the webinar. During the presentation, feel free to write in any questions you have using the Q&A link on the webinar menu. Then at the end of the presentation, we'll take some time to go through these. With that said, I'd like to introduce our guest speaker, Chris Hennessey, member of the Putnam Business Advisory Group, Putnam's National Speaking Bureau. Chris has extensive consulting experience in all areas of wealth management and often speaks at various national and regional meetings. He currently serves as a trustee for a private college and is a co-founder of an investment advisory firm. Along with a background in law, Chris has previously served as a former academic dean of the Babson College undergraduate program, as well as co-acting dean of Babson Executive Education. We are all very excited to have Chris here to share some insight on the current income and estate tax landscape, and I would like to thank Chris for joining us today. And with that said, Chris, I'll now turn it over to you.
Thank you very much for the kind introduction. Good afternoon or good morning to everyone. It's afternoon where I am, probably morning where you may be. And I'm happy to take you through this. The plan is to go about, and then I will turn it back for any questions that you may have. I always sort of start this presentation by asking folks in an audience where they were at 2 a.m. on New Year's Day, and that question provokes interesting answers. I don't remember, I don't want to comment, or I'm asleep. But in any event, that's about the point in time when the United States Senate passed what's known as the American Tax Relief Act of 2012. So one of the big fiscal cliffs, given the title of this presentation, was in fact the Bush tax cuts simply expiring. And they did expire, and then of course after they expired, they came back with this legislation. Let me just advance to the second slide here. And with this legislation that we now have, known as the American Tax Relief Act of 2012, that was one fiscal cliff. Now, there are some other fiscal cliffs that are coming up, and two of them have been solved. So one that was solved was sequestration, maybe not solved to everyone's satisfaction. A second one that was solved was simply keeping the government going, because Congress had to do that with a resolution since there's been no budget. And the next one actually is just about to occur, or actually has occurred. It was May 18th, I believe, was the due date, and that was the debt ceiling. However, the Secretary of Treasury has the right to push that out another 3 months, so that'll be September. So what I want to, and we'll come back to that in a few minutes, what I want to do with this slide deck is maybe three things. One, just sort of educate you as to what's in this new law. How does it impact you? Secondly, there are two new taxes, as you can see on this slide, and that's primarily around the Medicare surtax. Thirdly, I'm going to show you a couple slides that connect back to the economy. Where are we headed? What's the longer-term outlook? What's going to happen in Washington? And then I think, fourthly, the most important thing is, what are the planning considerations for you? What do you have to think about? So some of this law, most of this law is permanent. First bullet point on this slide. Now, when I use the word permanent, it's kind of like saying jumbo shrimp and adult children. It's only in the context that in the past, many of these provisions have sunsetted, so we really haven't had permanent law for the last 12 years. Now, that doesn't mean Congress can't change these things. They can, but it's unlikely they're going to change what's in this act. I'll get to what I think will happen next later on. For the most part, a lot of this stuff was extended, the tax provisions. But we're going to see in a minute or so here that there are some deductions that have been reduced. A good thing is that if some of you are familiar with the alternative minimum tax, they took the exemption amount, which Congress had to go back every year and index for inflation, and they made that indexing permanent, so Congress doesn't have to do that anymore. And as many of you are aware, the unemployment benefits went back up, or extended, I should say, but the Social Security tax went back up to 6.2%. Now, a lot of stuff on this slide, so let me step you through it slowly. The first thing is the simple tax rates. So as you can see, everyone is going to stay the same as they've been in 2012 with one exception. And that exception is if you are married and you're, I just got a little pop up I can right up. Sorry about that. If you're married and your income's over $450,000 taxable, or single over $400,000 taxable, by the word taxable I mean bottom line income, so gross income less deductions, then your rate goes from 35% to 39.6%. Everyone else is going to stay the same, so that's actually good. This only impacts about 1% of all taxpayers. Second item was very controversial last year as to what would happen, the dividend and capital gains rate. So again, it's going to stay at 15% unless you're over that 400 or 450. If you are, you actually have a 20% rate. Now it's really 23.8%, so it's confusing. Let me tell you why. We're going to get to this in a separate slide. There is a 3.8% Medicare surtax, which begins this year. The threshold dollar amount for that surtax is over 200 or over 250 if you're married, and that's top line income. So it's not gross, but it's close to gross income. So if my top line is over 200 or 250, by definition, my bottom line has to be higher than 400 or 450. So in that scenario, you're really going to have a capital gains dividend rate of 23.8, 20 plus 3.8. Now, clearly some people are going to be over the 200 or 250, but under the 400, 450, they're going to be at 15 plus 3.8 or 18.8. And then some will be under everything. They'll stay at 15. So that's the dividends capital gains rate. Itemized deductions. That's the only thing I want to cover in this next point. I won't cover personal exemptions. There's a phase-out. You can see the threshold amounts. Again, it's adjusted gross income, so basically top line of either 250 or 300. And for most of us, as we think about itemized deductions, is that bucket of mortgage interest, home equity line interest, state and local taxes, so state income taxes if you have that, real estate taxes, and charitable gifts. For every dollar you're over the threshold amount, you lose 3 cents on the dollar of your itemized deductions. So easy example, married couple, $1 million total income, their threshold's $300,000. They're over the threshold by 700. If I multiply 700 times 3, 21,000, I'm going to lose 21,000 on my itemized deductions. I can never lose more than 80%. So that's a cap. And I already mentioned the AMT, but it gives you an idea of what, in the very bottom of the slide, the AMT exemption amounts are. Now I can tell you those exemption amounts begin to phase out also. There's no change here. This has been in the law. Once you're over 150,000 of HEI. So in any event, the changes are significant, but I think even more of a game changer with what I'm going to cover next, which is the estate tax. And think about yourself in sort of two different categories. There are going to be married couples under $10.5 million. Now, how do I get to $10.5 million? Well, last year there was a $5 million exemption amount, and it was actually indexed for inflation, so it was $5.13 million. And that was going to expire without legislation and drop to $1 million. Now, everyone thought the legislation would pin it at $3.5 million. None of that happened. It ended up that they kept the 5, made it permanent law, and as you can see on the slide, indexed for inflation. So it's actually this year $5.25 million per person, meaning a married couple can shelter $10.5 million in value. And it's a combined amount. So that means that if I were to give away $2 million today, then I've used up 2 of my 5 1/4, and I have $3.25 million left to shelter value in my estate. So the first category is married couple under 10.5, and they're never going to get over 10.5. They really need to have planning done. I'm going to get to that in a minute. For those of you or folks that are over 10.5 million, it's planning as usual in terms of advanced estate planning. And we'll look at some of that at the very end of the presentation, but maybe with some expediency because the Obama administration wants to make a lot of the advanced stuff less favorable than it is today. Now notice the rate went up to 40%, and then there's this wonderful thing called portability. So instead of trying to just read the slide, let me give you an example to pull this together. And let's assume that I have $3 million in my name, and it's all Apple stock. It's worth $3 million. My cost basis is 0. Why? Because I'm a founder in Apple. None of this is true. I'm just making it up. My wife also has $3 million, so we're at $6 million total, and I die first. Almost always in that scenario, there's a trust set up, and that trust comes into play at my death, and everything in my estate up to the magical exemption amount of 5 1/4 will go into that trust. So in this case, $3 million worth of Apple stock will go into the trust. Now also there's something called step-up, which some of you are familiar with. So my 0 tax cost basis gets stepped up to $3 million, and the basis of the Apple stock in the trust is 3. A number of years goes by, my wife subsequently dies. The Apple stock in that trust is not part of her estate, and it's now grown to value, by the way, from $3 million to $4 million. But there's no second step up within the trust. So she dies, whatever's in her estate gets stepped up at her death, but there's no second step up. So the trust terminates, the Apple stock gets distributed to my children. The cost basis from my first death is $3 million. The value is 4. They sell it, they get a $1 million capital gain. That gain could have been avoided. And by the way, that capital gain will cost about $238,000. Here's how you avoid it. Go back to the original premise that I died first, but at my death, I don't fund the Apple stock into the trust. I leave it directly to my wife, Susan. So step up at that point in time from 0 to $3 million. Now, when she subsequently dies and the Apple stock's worth 4, it gets stepped up again from 3 to 4 because she owned it at death. And that's the whole key. That'll avoid this capital gain. Now, if you're doing the math, and I'm doing this example kind of quickly, you realize that, my gosh, Chris, if you left her Apple stock worth 3 and then it grew to 4 and she had her own $3 million, that's a $7 million estate at her death. She's only got a $5.25 million exemption. She's got to pay an estate tax. And the answer to that is no. And that's the big game changer. That's what's changed. What's changed is she won't pay a federal estate tax. And here's the reason. It's portability. She gets to take over the exemption amount that I never used. When I died, because I left it all to her, the Apple stock, I never used up any of my 5 1/4. So it actually transfers to her, as you can see from the bottom bullet point on portability. So she's got her own $5.25 million plus $5.25 from me. She's got $10.5 million in total exemption, $7 million estate. She pays 0. So anyone under 10.5 that's never expected to go over 10.5 really should rethink whether they want a trust at the first death because of the step-up issue I just described. Now, clearly, there will be the need sometimes for a trust, particularly second marriages, where you're worried about the children from the first marriage getting an inheritance, in my case, the Apple stock that I left to my wife, Susan, if she remarries. But I can handle that with a different type of trust called a Q-tip trust, and I still can get the 2 step-up. So there are ways that can be dealt with. Now, the other point I want to make is that portability only applies to the last dead spouse. So, for example, if I'm dead and Susan remarries, my wife, and she doesn't realize that husband number 2 used up his exemption amount already through gifting last year, well, she's still okay because I'm the last dead spouse. But if husband number 2 dies, she's going to lose the 5 1/4 she got from me, and she's going to get 0 from him, and she's back to the original 5 1/4. So in second marriages, I should say, literally what's happening today is people are doing prenups in which they must disclose how much, if any, of that exemption amount they've used up. So anyway, that's the estate tax. I think that's a huge, huge game changer. Now let me push on. In this slide, I only want to cover the second item. There's an interesting provision, tax-free IRA distributions. In the law last year, expired. They brought it back for 2013 only. So once I hit age 70.5, and this only applies if you're over the age of 70.5, I must begin to pull money out of IRAs and retirement accounts. And of course, that's tax free. This provision actually allows you, and you can do it up to $100,000, to move money directly from the custodian of the IRA to a public charity or charities of your choice. And when you do so, that distribution is not counted as income. And that's even better and having it counted as income and then turning around and writing checks to charities, because since it's not counted as income using this provision, doesn't impact any of those threshold dollar amounts that I mentioned earlier. So most people that do this, they do it on their minimum distribution amount. So if I had a minimum that I have to take out of my IRA of $40,000, I just say, okay, that 40 grand I'm going to leave to my alma mater directly, and then it's not taxed to me at all. So it's a really good provision to use. It will expire at the end of this year. Hopefully Congress will make it permanent law. That's my hope. Who knows? Okay. This is a insidious tax in my opinion. And the reason I'm a little cynical about this tax is a lot of people in 2013 aren't going to even know it's around. And they're not going to do any planning. And all of a sudden they're going to get their 2013 tax return sometime in April or March of 2014, and they're going to pay this tax, and they're going to be furious. So it, first of all, only impacts, and I mentioned this quickly earlier, more than $200,000 or $250,000 for couples. And it's a 3.8% tax. It's a separate tax on payroll, as you can see in the second bullet point. And it applies to interest, dividends, capital gains, rental income, and passive business income, all subject to this tax. Now, be careful with the computation. It does not apply from $1. It only applies to the extent you're over the threshold amounts. So again, to try to use an easy example, if a married couple had total income of $300,000 all from dividends, their threshold is $250,000. They're over the threshold by 50 grand. So the 3.8 is on the 3.8% is on the 50. It's not from $1. Also note at the very bottom of the slide that muni bond interest is not subject to this surtax at all. So even in states like Florida and Texas and Nevada, where there's no state income tax, people are going to look at this and say, okay, there's no huge advantage to buying a state municipal bond, but there could be for federal purposes to avoid this surtax. And the surtax, as you can notice from the bottom of the slide, will not apply to distributions from retirement accounts, and that's true, but those distributions push up your income, and they push up all the thresholds, so you have to be careful of that. Now, what's this stuff about passive? Well, interestingly, investors that have put money into an S-Corp or a LLC or a pass-through entity, but they're not active in the business, they're just a passive investor, they're going to get hit with this surtax if they're above the threshold dollar amount. Some people make investments in REITs or master limited partnerships. REITs would be a real estate investment trust. And those entities sometimes distribute what's called return of capital or return of principal. That is not subject to the surtax, so that's a good thing. However, it does bring down your cost basis in the entity, so it could increase your capital gain later on. So you've got this new 3.8. You've also got that increase in payroll tax on wages. It's 1.45% to 2.35. It's thus 0.9%. So you're really dealing now with primarily 4 different taxes: the regular old income tax that we've had forever, the alternative minimum tax, which has been in the law since 1970, Medicare surtax 3.8, Medicare tax on payroll 0.9. Some people are going to pay all 4. There are 4 different tax computations, so you really got to pay attention to this and try to do some planning. Okay, I'm going to skip that slide. Now there's one slide I want to show you, which is this one right here. Because people will often ask me, where are we headed? Is there going to be another tax increase? Why is there so much of a push looking at, we need more revenue, we need more revenue? Well, this slide basically explains it. And when you look at the entire budget of the United States, and notice that these numbers are based on the year ending September of 2012, which is the government's fiscal year. But in any event, when you look at the entire budget, 65% of the entire budget of the United States is locked in mandatory spending. Now, as you can see, we're defining that as, and you can see the raw numbers on the slide: Social Security, Medicare, Medicaid, interest on the debt. Now, the other category is pretty big. That other category represents government retired government employees' retirement, because they don't get Social Security, and veterans benefits to retired military and veterans. That number is almost as big as Social Security. So when you add those numbers up in raw dollars, it's $2.4 trillion. The entire revenue base in the United States is about $2.9 trillion. We're spending about, CBO just revised it down a little, we're spending about 3.6. So until there's a fix on required autopilot spending, the 65%, we're going to have problems. We're going to have revenue problems. Well, we're going to have problems pushing for increased revenue is a better way to say it. Now, just a footnote on this slide. I heard Ernst & Bowles speak in Boston about 3 months ago. You probably remember the Simpson-Bowles report, 18-member bipartisan panel, reported back out in 2010. But by the way, they didn't call it Bowles-Simpson because it would have come out BS as the initials. That would not have been good down in D.C. But Ernst got up there and he said, look it, and he talked primarily about Social Security. You can't grow your way out of this problem. You can't tax your way out of this problem. You got to fix the problem. And until we fix it, we're going to have huge issues around spending and around pushes for increased revenue. So it just gives you a little bit of perspective. The number on this slide, by the way, they all scared me, all these numbers, but the one down the bottom, the interest on the debt, that really scares me. Because we're looking at a 10-year treasury today of about 1.94, 1.95. Historically, that number is more like 4.5%. If it went back up to the historical level, it would cost the government another $500 billion. So you kind of get a sense of why Bernanke has to keep the interest rates low. Okay, we're not going to get, in my view, a longer-term solution. There is some discussion now of a mini grand bargain. I don't even think that'll happen, but let me try to give you a little perspective on what's going on. So the next fight in September will be around the debt ceiling. The Republicans have said, yeah, we'll raise the debt ceiling. We're happy to do that. However, in exchange, the Democrats have to give us meaningful cuts in entitlement spending. And the Democrats are saying, no, we don't want to do that without a tax increase. So that's what the fight's going to be around. In addition to that, Obama wants to get rid of sequestration. He submitted a budget which is very controversial. It's going no place, but he wants to limit your retirement accounts to 3.4 million and a number of other things. And I'm happy to answer any questions on that. And there's, of course, a budget from the Democrats and a budget from the Republicans. So planning, just to kind of get to the planning here the next 10 or so minutes before we finish up. So I mentioned muni bonds. They're certainly more attractive because people are being pushed into a higher rate. Now, the second item, before I even get to the details of that second item, as tax rates go up, people rethink their entire situation. And I'm reminded of the comment Phil Mickelson made at Torrey Pines, which is the week before he won the Phoenix Open. Now, you have to understand, Phil was a resident domiciled in California. And he said, I got to do something. I'm paying a 63% tax rate. Now, that was combined. I think California's 12 to 13%, plus his federal. And he's going to move to Florida because he wants to get rid of the state income tax. In my own situation, I was in California last week, all week, speaking, and I said, I'm not going to pick on California. I'll pick on Massachusetts, where I live. I'm not going to die here. Now, actually, I should technically say I'm not going to die domiciled here. Why? Because we have an estate tax. And once you're over $1 million, you pay almost 16%. Your estate will. I'm not going to give that money to Massachusetts. I'm going to end up dying probably domiciled in Florida. And frankly, our state income tax is at almost 6%. So people rethink those types of things. And they rethink at the federal level just basic tax planning. So, for example, the second point on this slide, maxing out retirement accounts. Small businesses, they definitely should have a retirement plan, even if it's just a solo K or a regular 401k plan. And you should be maxing that out to try to get the deduction. Now, I'll give you another way to think about this. Married couple, let's assume, both working, 3 children. They both have good incomes, both have good jobs. They could max everything out. They could each max out their 401k plan at $17,500 each, so that's $35,000. They got kids, so they could do a dependent savings account, $5,000 a family. That brings them up to $40,000. If they had a high deductible health care plan, they could do a health spending account, HSA. That's $6,400, I think it is. So now they're up to, let's see, 40. They're up to $46,000, and then they could do flexible spending accounts. The limit on that this year is $2,500 each. They're up to $51,000 pre-tax. So it helps all those limits, all those thresholds, doesn't impact them, really helps their tax bill. So that's something to really think about in the future. And then I did another event. I did an event out in California last week, it was interesting. A lot of wealthy people in the room, and they're really going to max out their charitable contributions. And just a footnote on that, again, in Obama's budget proposal, he'd like to limit the benefit of all itemized deductions to 28%. So that means if you were in a 39.6% marginal tax rate, which is the top tax rate today, and you gave $10,000 to a charity, you should save $3,960, 39.6%. You'd only save $2,800. Now, if it looks as if at some point this is going to become law, then people with a charitable pledge, a 3-4 year pledge, they ought to pay it off to get the full tax benefit before that goes into effect. So those are just some things that you have to be careful of. Interesting point in the slide, be careful with transactions that could drastically increase your income, like a large capital gain. Maybe if you've got a large capital gain, maybe you try to offset that with a capital loss. Maybe you take some big capital gain this year and some next year, just to try to keep at those threshold dollar amounts we discussed earlier. Or if you're going to go over those threshold dollar amounts, try not to go over that much. And then there's the Roth. So, the quick background on the Roth, for many, many years, and I'm sure you're familiar with this, we've had regular IRA accounts, and you can put money in on a tax-deductible basis, and of course those funds grow, and you take them out, what you put in plus any growth is income tax due, and you got to pull it out at age 70 and a half. Bill Roth, a U.S. Senator, came up with this idea that we now call the Roth IRA. Okay. You put money into the Roth and you put it in after tax, but it grows in value, and when you take it out, it's tax-free. And by the way, you don't have to take it out at all at age 70 and a half, at least if you're the owner of the account and his or her spouse. So the question is, does the Roth now make sense? And along the way, historically, there were a lot of people that had regular IRAs or 401k plans or some type of retirement plan. They said, we'd really like to make this plan into a Roth. And we call that in the business, of course, a Roth conversion. But they couldn't do that because their income was over 100 grand. Well, that restriction was lifted beginning in 2010, so now anyone can do a what's called a Roth conversion. This legislation didn't impact the Roth at all. There's no change at all. So I think people saying, all right, well, the tax rates have gone up. Maybe I should get a Roth IRA, get a tax-free bucket down the road in time. And I think the folks that have done the Roth, it's a hedge. So they're really saying, hey, I don't know what my tax bracket is going to be 20 years from now, 10 years from now, but I'm going to hedge. It may be the same as today or higher. So I'll convert 10% or maybe 15% of my retirement accounts into a Roth IRA. The people that I speak to when I do client shareholder events, their biggest issue with the Roth is twofold. One, they don't trust Congress, that Congress could change the rules of the game on the Roth. But secondly, they're worried about the taxes they have to pay when they do the conversion. So any way you can minimize that tax hit is great. And I'll just mention three, and they won't apply to everyone on the call. One is a business loss. So if you had a business and you were a sole proprietor and you had a bad year 2 or 3 years ago, that's called a net operating loss. And that loss can actually be carried forward in time for up to 20 years. So if I came into 2013 with a carry forward loss of $150,000, I could do a $150,000 Roth conversion tax-free. In other words, one offsets the other dollar for dollar. Two others that are very analogous. If you ever had a non-variable annuity, so it was an annuity that you invested in sub-accounts, and unfortunately you did it at the height of the market, and now it's gone down in value, and you're underwater 100 grand in the annuity. If you surrender that annuity, there's a 1961 tax ruling that indicates, in my example, you could take a $100,000 deduction, dollar for dollar against income, front page of the tax return. And then same concept, underwater college savings plan. And I'm the owner of the account. The account's underwater. Unfortunately, that's much more restricted. You can't deduct that if you're an AMT, and there's a floor in the deduction. And then finally, just thinking about, okay, maybe this is the year I make a big charitable gift. Maybe I do that directly to a charity. Maybe I do that in the format of a charitable trust, and then I offset that deduction with a Roth conversion. Or maybe I do a little Roth conversion this year and a little bit more next year because I'm trying to stay under those threshold amounts. So the Roth is definitely something to think about. Now, just moving on, I mentioned point number 3, this maximum of $100,000. a much better way of writing a check to a charity. And let me add one point that I think I did not mention before. In many, many states, if you use this provision, then you don't get taxed for state income tax purposes either. I was told out in California that applies. So in other words, let's assume I've got a $40,000 required distribution from my IRA. I pull the $40,000, the custodian I direct to pull that money out and goes right to a public charity. Then I don't have to pay income tax on the 40 at the state level in addition to the federal level. So that's a real advantage. Fourth item, I mentioned portability. You really need to get your estate plan looked at. Don't forget about the fact, as I told you in Massachusetts, that there are many, many states that have a separate estate or inheritance tax. So although you married may well be under the 10.5, you may still have to do some planning at the state level. And do review those trusts, because you may not need the trust. Now clearly, I always kind of throw this one out to an audience to see if they can figure this one out. Well, a famous American died August 16th, 1977. Well, the answer is Elvis Presley died that day. And he died with about a $10 million estate, poorly written last will and testament, 12 years of probate, 73% went to lawyers. So you might need a revocable living trust to avoid probate, but that has nothing to do with the step-up issue that I mentioned earlier. That's still a smart thing to do, just to avoid probate. And of course, you want to make sure your durable power of attorney, your healthcare proxy, all that stuff is up to date. Now, the complicated stuff, if you're over 10.5, then you're going to have a federal estate tax liability. And you may think about things like GRATs, the Grant to Retain Annuity Trusts, SLATs, Family Limited Partnerships, Dynasty Trusts, all those things. And under the budget proposal the President has submitted, all of those items would be less favorable than they are today, or they wouldn't work at all. So if you were thinking about any of those items, then get the planning done now, because if you got the documents done now, you'd be grandfathered. That's really an important thing, to just push this, to do it with some expediency, because I'm afraid some of this could change. I'm not sure that this will happen in this go-around in September, but I just don't know. It could happen. And the first point is, when you think about your own situation, if a lot of your net worth is in non-liquid assets, the classic example is real estate or a closely held business, but also a retirement account. Retirement accounts, sure, if I died and I had a large IRA account, my children can say to whoever the custodian is, sell all the assets, put them into cash. But you'd hate to force those kids to pull the cash out of that account to pay the death taxes of my estate, because it would all be taxed on the way out. So any of those categories that exist, you really think about life insurance as providing instant liquidity. And of course, if that life insurance is owned by an insurance trust, then it's income tax-free and estate tax-free. And just another kind of note on life insurance is tax rates move up, life insurance becomes an interesting alternative investment, at least a policy that has value, because the growth in that value is either tax-free or tax-deferred. And likewise, annuities. It's just something to rethink now, because we've had a tax increase. So just sort of closing thoughts, and then I'm going to turn it back over for questions, maybe add a little bit to what's on this slide of closing thoughts. I think probably we will not see under the current Congress a tax increase. I just think everything in Washington, D.C. is so partisan right now that it's unlikely that the Republicans controlling the House of Representatives would allow any type of tax increase unless there was real meaningful progress towards cutting entitlement spending, and that would be primarily, the big numbers would be Social Security and Medicare. Social Security's pretty easy. What Erskine Bowles spoke about was, hey, 40 years from now, you raise the age by 1 year, in another 25 years, it actually wasn't from now, it's from 2010, another 25 years, you raise it by 2 years. And along the way, you take the wage base for Social Security, which today is about 113,000 or so, and you raise it to about 140,000. That fixes Social Security. Medicare is much more difficult because it's a combination of different things, but they have to meaningfully go after those items. Basically, if you wanted to balance the U.S. budget today, just balance budget, and this is, by the way, these numbers are over a 10-year time frame. You'd have to either cut $4 trillion over 10 years, increase taxes by $4 trillion over 10 years, or combination thereof. If you wanted to get the budget to a level more historical, and by the way, more historical would be that the revenue coming in is about 18.5% of our gross domestic product today. It's about 15.5%, and the spending going out is about 20% of gross domestic product today. That number is about 26%. If you wanted to get those numbers more in line with history, you'd have to come up with $2 trillion. We're nowhere close to that. So that's what I think is going to happen in this next round. Now, after the midterm elections in 2014, then it'll depend on how those elections come out. I can tell you that the money for the future, if they want to increase revenue, the money is in itemized deductions. If I were to show you a slide with the top 10 items, the biggest tax breaks we get as individuals. Number one, when our company pays part of our health care insurance as a benefit, that's not income to us. That's the biggest tax break we get. Number 3 is the mortgage interest deduction. Number 8 is the fact that we're allowed to deduct state income taxes, real estate taxes, and number 9, we're allowed to deduct charity. So in the future, that's what they're going to go after. I mean, that's really Obama's 28% proposal that I mentioned earlier. But I just don't see that happening under this Congress. But if they cut a deal and there is meaningful entitlement spending, there could be a future tax increase. So, you know, in this environment where there's a lot of uncertainty, you really want to think about tax diversification and looking at some of the strategies or all the strategies that I mentioned today so that you won't get hit with a big surprise as we go into, as you look at your 2013 tax return as we get into March or April of 2014. So I'm gonna stop there and see, just tee it up and see if there are any questions.
Thank you so much, Chris. That was a very informative presentation. We'll now start addressing some of the questions that have been filtering in, and please remember that if you have any questions, you can submit them using the Q&A tool on the webinar menu. As always, for any plan-specific questions, you can always reach out to your dedicated service team here at Pensionmark. And as we wait for questions to filter in, I'd like to take a minute to let everyone know that you can stay up to date on the latest retirement plan news and events via Pensionmark's Facebook, Twitter, LinkedIn, and we are now on YouTube as well. In addition, we'll be posting the replay of the webinar on our website on the Investor Education Center, as well as our YouTube page within 10 business days. And with that said, we'll now move on to our first question.
Sure.
Could you expand more on Obama's budget proposal regarding retirement savings?
Oh, sure. So there is a proposal to, in essence, limit retirement accounts, including IRAs, to a value of $3.4 million. Now, the way you get to that number is currently the maximum defined benefit payout is $205,000 a year. So you take that 205 times an annuity factor based on interest rates, and you come out with $3.4 million. Now, interestingly, as interest rates rise, which they will eventually, that $3.4 million number will come down. So it doesn't mean that you have to pull money out if you're over 3.4, but it would mean you couldn't add any more money to the retirement plan. And of course, the plan could still grow in value, or the account could still grow in value, but you couldn't add any more. So that's what that's about. Now, again, although I'm getting a lot of questions on this, I don't think his budget proposal is going anyplace. However, it kind of gives you, I think it sets up a mindset. It sets up a thinking of, okay, where can we go after next? Now, I did an event last week. It was a financial advisor event that I did in Denver. And one of the advisors there said, you know, what about excise taxes on retirement accounts? That could happen. What about a value-added tax, a national sales tax? That could happen. I mean, so there's all sorts of different pockets that they could go after. But anyway, in response to the question, that's what that's about.
Great. Thank you so much, Chris. The next question we have coming in is, if you had 3 high-level takeaways regarding action items as related to the tax perspective, what would you summarize those to be?
Sure. So I would say the first takeaway I would have is estate planning, because I think There are a ton of people out there that are under that, married couples under the 10.5 million that have set up the trust, which we usually call the AB trust or the family trust. They really need to go back and get their estate planning looked at, particularly if they have assets that are stepped up in value, that are appreciated in value. So that's number one. Number two would be the Medicare surtax. I think it's this 3.8% is very insidious, and there are ways to plan to minimize it. I mean, one of the ways I didn't even mention is, okay, if I've got a lot of dividend-paying stocks and mutual funds, maybe I shift away from that and I look at more growth that's not spinning off a lot of income. So that would be the second one. And the third one, I wouldn't point to one item. I would just say review your entire tax planning strategy in view of the fact that the rates have gone up. Those would be my three.
Perfect. Thank you so much, Chris. And it doesn't look like we have any more questions coming in at this time, so that will conclude our question and answer period. And if anyone has any additional questions, please feel free to reach out to your dedicated service team here at Pensionmark. I thank you all for joining us today, and once again, Chris, I would like to thank you for taking the time to present today.
Thanks very much.
And
Appreciate it.
this now concludes the webinar. Thank you.